Hello and welcome to Pring Turner's 2026 Mid-Year Financial Outlook and Portfolio Review. Joining us today are amazing co-founders Martin Pring and Joe Turner, as well as our lead portfolio managers, Tom and Jim Kopis. Now, before we get things started, as a friendly reminder, everything that is shared today is for informational purposes only. It's not specific investment advice. As well, the views of the team are subject to change over time, just as market conditions and other factors change over time. Now, with that, Martin, Joe, Tom, and Jim, they're going to talk about our 50 years in the business and what that's taught us, as well as to review where we are in the business cycle, what we're doing about it, and what we think comes next. And then thank you to everyone who submitted questions before the event. We're going to answer those first at the end, and then we're going to open the floor up to a live Q&A. So if you have any questions that pop up along the way, feel free to share those in the chat or Q&A feature, and we will be sure to get to as many as possible before the top of the hour. Now, with that, I'm going to pass the mic on over to Tom.
Okay, thank you, Pamela. And can't believe it's already halfway through 2026. Here it is, July. And welcome, everybody. Also, happy 250th anniversary to our country. So we just had the 4th of July and all that celebration. Well, Pring Turner's celebrating 50 years as an independent registered investment advisory. So that's a milestone. And 50 out of those 250 years, Pring Turner has been helping folks like you manage wealth. So we're pretty proud of that. And as we said in one of our recent newsletters, not our first rodeo. What we mean by that is we've been through a lot of cycles, market cycles, business cycles over that 50 years. So we are lucky to have our founders here. Joe Turner, the original founder, is here to pass along some of his insights looking back over those years. So Joe, why don't you tell us about the 1970s through today and what it was like?
Oh, you make me feel so old, Tom. But that's the advantage I think that Pring Turner offers is there's a deep reservoir of experience and knowledge and wisdom that comes from that experience. And actually, the history goes back even further than 50 years because the first 8 or 10 years before becoming an independent advisor was time that I spent learning and growing and developing a philosophy and a decision-making process that a disciplined decision-making process that we use today. We've seen a lot, as Tom here has pointed out. Certainly, the 70s were a period of inflation, high inflation, and a lot of volatility in the markets. But the decision-making process that we have developed has been able to go through all of that. And the experience that we've had, as an example, Tom mentioned business cycles. Well, the United States has experienced 35 business cycles going back to the 1850s. As your managers, we've experienced 8 of those business cycles. We've experienced the longest expansions in American history. We've had the shortest recession in American history. On our watch, we've experienced the highest interest rates that America ever had. And those of you that were clients even 6 years ago have experienced the lowest interest rates in American history. So we've been through a lot of ups and downs in all of that. Probably one of the most exciting time periods for us was October 1987, when the market celebrated Black Monday, they call it today, but the Dow Jones dropped 22.5% in one day. And to put that into perspective, folks, if you're sitting down or hold on to your chair, today's equivalent would be the Dow Jones sinking 11,960 points in one day. But through that all, we've done a great job, I think, building wealth for our clients and protecting them when those tough times come along. So We have a pretty deep team of experience in that 50 years. Very few firms can offer that to their clients. Uh, a lot of that time was spent developing and nurturing my knowledge from one of my partners, Martin Pring. And I'm going to turn this part uh, of bringing us up to date on the current business cycle and what it looks like and where we are. So I'm going to turn this over to um, our beloved other founder, Martin Pring.
Thank you, Joe. Yes, you still are a friend, and a very treasured one, too. Today, I'm going to be talking about two important influences on the market, and those are the economy and swings in confidence. Here's a chart of the S&P Composite going back to 1952, and you notice that all of the major declines are taking place in one of these ellipses. Well, these ellipses represent economic events, either recessions, which are in pink, or their growth recessions or slowdowns, which are in blue. And generally speaking, you can see that the pink circles or ellipses are much larger than the blue ones, which means that the economic damage is much greater. And when the economic damage is much greater in a recession and in a slowdown, then the stock market suffers accordingly. And of course, the stock market peaks ahead of the recession too. So let's just take a closer look at where we are right now. So this chart shows the inflation-adjusted NYSE composite. And underneath, I've got two momentum indicators. One is an economic one, a long leading indicator, which is future capital spending, which is published by the Philadelphia Fed. And underneath is the NYSE momentum. That's the momentum for the series at the top. And you can see that the two momentum series move not exactly tick for tick, but there's no question that they're moving in the same direction during the course of each individual cycle. You'll also notice some red vertical lines here, and those lines are there to identify periods when the capital spending, the black line, crosses below its moving average, the red line. And what happens when that happens, it indicates that the economy is coming down, has peaked, and that's not good for stocks because you can see each time you get one of these red lines, vertical lines, the stock market comes down to some degree. Sometimes it's very severe, like 2009, and sometimes it's less severe. So at the present time, we've got all the indicators in a positive mode. The NYSE composite in the top panel is above its dash moving average, and the future capital spending is above its average, and the NYSE momentum is also above its average, but it's getting pretty close. But right now they're all bullish, they're all positive, which is bullish, and that's a good thing, obviously. But one caveat here is that we're not in the kind of situation we were in 1923, which was when everything was below zero and starting to turn up. We are quite somewhere above the equilibrium point at zero. So the economy is kind of mature at this point. The stock market rally is quite mature at this point. That suggests that there could be growing risk going forwards, although we don't know when it's going to turn. We're going to watch for it to turn, and that will give us a very nice signal. So if it's at a mature stage, that means capacity is being used up. And when capacity is being used up, that means that inflation is being pressured. And the next chart shows the inflation-adjusted S&P composite this time, and underneath is an 18-month rate of change of the CPI. Now, we normally look at the CPI on an annualized rate of change, a 12-month rate of change, but I prefer the 18-month because it's half of the business cycle, which if you include slowdowns and recessions, has averaged 40 months since the 19th century. And the second reason I like this 18-month rather than a 12-month is it's less volatile. Well, the thing about inflation is that stocks can deal with a certain amount of inflation or a certain amount of deflation. But when it gets out of hand, that's very unstable for the economy, and stock prices experience some problems. So the red highlights that we have here indicate periods when the rate of change is above 5%, above that red horizontal line, and it's above its moving average. So in other words, we're using the moving average to kind of identify the trend. So it's an upward trend above 5%. That's where we get one of these red highlights, which is not very good for stock prices, as you can see. And the blue highlights represent the opposite situation when we have deflation, when the rate of change is at or below -3%. Right now, you can see that in the last couple of months, the rate of change has moved above the 5 level, which indicate, and it's getting a red highlight. So it indicates we're in the danger area. Now, recent declines in the, as this data lags, recent declines in the oil market may kind of moderate this indicator a little bit for a while. But if it continues to build on itself, that's going to get to be a very dangerous point, and that's when we need to be concerned. So finally, we were talking about confidence, and we're going to compare the inflation-adjusted NYSE composite to margin debt momentum. But before we look at margin debt momentum, I want you to notice that the red highlights here represent recessions. And before the red highlight begins, you can see that the black line, which is the inflation-adjusted stock market, begins to discount the recession. You can see from the red lines there, where the margin debt momentum peaks out, that is also a point when the stock market becomes a lot more risky. Because a lot of people think that margin debt is a problem when it gets high, but it's not really, as long as it keeps getting higher. It's the direction of the thing that is important, because when it's going higher, it means that money is flowing into the market, and that bids up the prices of the stocks. It's a positive thing. It also indicates because people are willing to take on more debt, but they have more confidence. So right now, the margin debt momentum is at a pretty high level, almost up to that overstretched dashed line there. So it's at a problem area, but it's still moving up higher. And as long as it continues to move up higher, and it could do that easily for 6 or 9 months, based on some of these previous examples, and it may turn next week. We don't know. We have to watch and wait and see. So I'd like to just summarize what I've said in these slides. Number one, stocks anticipate economic weakness and strength. 2, the economy is expanding, but it's reached a mature stage, so we have to be a little bit careful here. Number 3, the CPI has reached a warning level for stocks, and it needs to moderate. And finally, expanding margin debt is not bearish, but a downside reversal of momentum would mean that investors had started to lose confidence. And that's one thing that we don't want to see. So I'll now hand it over to Tom and Jim, or Jim and Tom.
Okay, thank you, Martin. That was great. So from what I'm hearing, the economy's still growing, but it's getting later in the cycle. So we're still positive, but there are some yellow flags out there. So we're going to, be on alert for any changes. We have to remember this bull market started in 3.5 years ago, and it's been 3.5 great years for stock prices. They don't go straight up forever, and we're paying attention to the business cycle and to the market cycle. The good news is that our Advanced Investment Barometer, which we featured here just in our most recent newsletter, is still positive. Now, the barometer is composed of about 10 different indicators, and it is our primary trend indicator that tells us whether or not we're in a positive or negative environment for the stock market generally. It's not perfect, but it's had a very good track record over the years, and definitely during the initial conflict with Iran earlier this year, the stock market declined, the barometer took a dip, as you can see on the far right side here. But with the rally we've had the last couple months, it has regained some strength. Maybe not quite back to where it was to start the year, but we're back in positive territory. And while that's in positive territory, we're going to continue to stay optimistic, but we're going to definitely pay attention. What does that mean for portfolios? Well, we taken that barometer analogy one step further. If we want to know, well, what's the investment climate today? We started the year in growth mode perfectly sunny skies. With the Iran conflict, we moved into the caution zone where maybe it was starting to rain a little bit, and we were concerned if things got worse, we would have maybe moved into protect zone. But the opposite happened. Oil prices have declined. It's given a little new life to the market, and the barometer moved back, I'd say, to the partly cloudy, partly sunny, but still growth mode. And I think Jim is going to help us show exactly what we've been doing in portfolios with these changes over the last few months.
Thanks, Tom. I'm going to talk about portfolio positioning, and it's important to keep in mind each of you have your own personalized portfolio, so your allocation will likely look different than these numbers here, but this is just an example to give you an idea of how we're managing risk through the current cycle. And for reference, this is for a conservative growth strategy. And typically, we'll range from about 30% if we're in that full protect mode, up to 70% in stocks in full growth mode. And as Tom pointed out, the investment barometer is still in growth mode, but it's come off its highs a little bit. And our intermediate model, which we call our fuel tank, has emptied a little as well. So while we're offensively positioned, we're not fully in growth mode. Bring up our allocation here to give you an idea. We're around 60%, which leaves us room to add. We're still, closer to growth, but we're not all the way there. And then moving on to bonds, we're in the later stages of the business cycle, as Martin pointed out. Inflation's running higher, and that's where interest rates tend to rise. So remember, bond prices move in the opposite direction of interest rates. So that's a higher risk environment for bonds, and we're keeping our bond allocation small at just 16%. It's a defensive position, and we can add to those. And finally, getting to cash, the last one, it's about 24%. That's really what's left over after the stock and bond investment decisions are made. It's a healthy level right now, and we think best of it is to think of it as dry powder that's ready to put to work. So if you just looked at the portfolio positioning of where it is today versus the beginning of the year, you might think that we've been asleep at the wheel. But if you take a look underneath the hood, we've actually had some rotation. On a couple of occasions so far this year, we've actually trimmed back some investments. You may remember in January, precious metal prices were soaring. Silver in particular had a huge run in a few weeks. I think it surged from like $71 to $121 in just a few weeks. And so we use that strength to trim back some of our precious metal royalty companies. We've also seen strong runs in other investments, AI beneficiaries and semiconductors in particular, where we've also taken some profits there and use those to redeploy those proceeds into other opportunities. And so a good example of that redeployment would be in software. Those stocks have been hit particularly hard on worries about AI. And I think the thought being that why would you pay a software provider when you could just build the tools yourself with AI? It's more nuanced than that, but we think this fear is a little bit overblown. In fact, it's possible that AI may end up being a tailwind for software companies, not a threat. So we saw good value there, still see it today, and redeployed some of our funds into those investments. And Pamela, I'll hand it off to you now to open up the question and answer section.
Awesome. Thank you, Jim. Now, with that, these were the questions that were submitted before the event, so we're going to go ahead and answer those. But if there are any others that, are unanswered or you still have questions for us, you still have time to submit them in the Q&A feature or chat feature, and we'll make sure we get to as many as possible at the end. All right, so the first question that came in is, should we be investing in AI? Who would like to take that one?
I'll take it, Pamela. And it's a good question, one that we're getting. And we actually are investing in AI, but very carefully. Reminds me of a story when my oldest daughter, Kate, was in 4th grade. She learned about California history. And one of the highlights was the gold rush. And I was actually able to chaperone a field trip to the Columbia State Park and get to experience the gold fever and gold panning firsthand. And what's fascinating about the gold rush is actually how few people struck it rich. In fact, you may not know this, but California's first millionaire was a man by the name of Samuel Brannan, and he never mined an ounce of gold. When he heard the gold rush was coming, he bought up every pick and shovel he could for 20 cents each and essentially cornered the market and was able to sell them in the streets of San Francisco for up to $15 each to frantic miners. So he made his fortune selling the tools, not swinging them himself. He made enough money to eventually buy about a quarter of the land in San Francisco and Sacramento, which is pretty amazing to think about. But then years later, he poured all of his money into the railroad boom in the 1870s, which coincidentally looks a lot like the AI boom today. And he ended up losing his entire fortune and died poor. So here's the thing, Brannan certainly didn't need help getting rich, but he did need help staying rich. And that story hit close to home to me because when I heard the story at Pring Turner, we're always talking about we're not trying to make you all rich. We're just trying to keep you all from becoming poor. And Brannan certainly could have used someone like this in his own world during his second act there. So what's the lesson? When you see a huge boom in a new technology, especially one that takes a lot of capital and capital requirements, it's often smarter and more reliable just to sell to the people doing the work than to try to strike it rich yourself. So with that in mind, how are we investing in AI? As I mentioned before, we're not really directly. Instead, we're investing in the things that AI needs: energy, electrical components, data center components, land, water, precious metals like copper. And the businesses that we invest in either tend to be the low-cost operators or even better yet, royalty companies. These are capital-light companies that basically get a royalty payment no matter what the price is, and they're very profitable. And so it's a lower risk way to invest in those companies. So all in all, yes, we're investing in AI. We're just not betting on a specific winner. We're betting that the race gets run.
Right. Thank you, Jim. And the next question was, are we in a bubble? Many compare today to 1999.
Okay, I'll take that one, Pamela. I'll start off, but yes, it's a lot of talk about bubbles lately and comparisons to the internet era, the mania that went on then, and there's a little bit of a mania going on now, and back in Silicon Valley in a different way. In one respect, there might actually be a bubble in bubble talk, at least. Well, we know that for sure. So there are a lot of similarities. Certainly stretched valuations and stock prices, narrow mega cap leadership, very familiar with what happened in the late 90s. Certainly the speculation in AI and more recently the SpaceX IPO, which generated so much interest from the public. Those kinds of things, it's kind of led to a euphoric sentiment, get rich quick kind of mentality. It's a little troubling for us, seeing what we went through in the late 90s. Our response is pretty basic, that we're just going to keep doing what we're doing. We're going to stay disciplined with position sizing. So if we happen to have something that does very well in the portfolio, maybe related to AI, that we'll be careful to trim it back appropriately. We'll stick with quality, value, and income ideas, and that helps to keep us from getting too concentrated in one area. For instance, technology in the late 90s, that was an area where a lot of investors mistakenly became over concentrated in that group. And it's fun on the way up, not so much fun on the way down. So the boom periods are great, the bust periods not so great. So by staying with our discipline process, we're going to avoid the downside of any bust that comes along.
Great. Thank you, Tom. And this next question, I'm going to pass it along to Joe. What market period most resembles today?
That was an interesting question, and one that uh, was difficult to answer because it's not really just what one market period. I think we can identify three time periods that most resemble today, and actually, uh, Martin, Tom, and Jim have all touched upon various aspects of that. And high valuations would be one of the characteristics of today. Now, it's not just that this particular business cycle or this particular bull market is long in the tooth, but if we go back and look at a secular basis, this market has had a tremendous run since 2009. So, really on a secular basis, we are 16, 17 years into this long stock market expansion, if you would. So, uh, reminiscent, as Tom pointed out about the .com, say in the 90s, reminds me today of the speculation that went on in the 60s. We call that the Nifty 50s. So we've gone through the Nifty 50s. We've gone through the .com mania of late 90s. And we see that today, as Tom pointed out, in both AI and in space. Characteristic number two is speculation. Tremendous amount of speculation. A lot of it we could measure, some of it we don't measure, but it sure has a familiar feel to it as to past speculative bubbles, if you would. Martin showed us margin debt, and that's been a huge increase in just the last few years. And if and as and when that unwinds, why that's going to be put pressure on stock prices. And the third characteristic is higher inflation, similar to what we saw in the late 60s or the 70s, up to 1980. Different surges of inflation with each business cycle. And this is something that we expressed our concern back when we did the client event back 4 years ago. So we put these three together, and I think the message here is we've gone through these before. We've done very well using disciplines to manage your portfolios. So I think putting these together, I would say the bottom line is keep dancing. As Tom pointed out, and Jim, we still have favorable tailwinds, but keep dancing, but move closer to the door.
Well, great. Thank you, Joe. Next question, I'm going to pass it along to Jim. Why have you been trimming investments that performed well?
Thanks, Pamela. Well, you might be surprised to hear this, but selling is actually harder than buying. And so it's a great question. Buying is fairly straightforward. We just look at the quality, the value, and the income of the investment. And if it meets that criteria and we like the potential returns versus how much risk it is, we'll buy it. But what's interesting about investing is even the best investors are only right a little bit more than half the time. And so that might not sound like really great odds, but you still can be a really successful investor even if you just have a 500 batting average, so to speak, as long as you do a couple things. One, you need to avoid the big losses. Can't have those strikeouts. And two, you want to let your winners run. Those are your home runs. And so when you have those home runs and those winners, some of them can grow to become a really large part of the investment portfolio. And that's a really good problem to have. We wish we had more of those, but it is also a bit of a risk. So we'll trim those positions back from time to time. It keeps us diversified and it frees up capital for potential new ideas. And another reason why we do that is when an investment has grown to become a substantial size in an account, it usually doesn't have the same as attractive characteristics as when we first purchased it. So the value may have eroded a little bit. So trimming isn't a prediction that it's going to go down. It's just risk management, and that's really one of our tenets here at Pring Turner.
Thank you, Jim. Next question, I'm going to pass it along to Tom, and that is, why are there so many portfolio changes this year?
Okay, and that's a good question, and someone's paying attention at least to what's going on in portfolios. So good to hear that. I think, number one, we're not traders. We definitely are investors, and we're looking at, especially for taxable accounts, for long-term capital gains. So you're not going to see us trading, but it's more about risk management. And some years require more activity than others. Certainly, as you're getting changes in the business cycle, we're getting near the tail end of the business cycle. Leadership tends to change. So that's, point number two here is we talked about this in our January newsletter, that there's a potential for a rotation away from last year's big winners, which are a lot of the mega cap tech stocks. And some of the trades this year reflect that. We're trimming some of those positions to reinvest in new areas. And lastly, we're always going to do this, any trading or changes in the portfolio with the idea that we're looking at quality, value, and income. If we can find, better quality, better value, better income, we're going to redeploy into those areas. So we're always looking at the portfolio through that lens of improving the quality of the portfolio.
Just to add there to what Tom was saying, I think this year and the markets in general have been pretty unique, and we're seeing more volatility in individual sectors or individual investments. These huge moves after earnings or after different news releases. And so I think we're trying to take advantage of those. If a stock is up, a huge stock is up billions of dollars, in market cap in a day and not really much news, that could be an opportunity to trim something back. Or if another position is down substantially, could be a good opportunity to add to that position. And it probably gets back to us getting in the later stages of this market or of this secular bull market that Joe talked about, where you could see some heightened volatility. And so we're going to just not sit there passively. We're going to try to take advantage of those opportunities.
Right. Those are really good thoughts. Thank you, Jim. And thank you, Tom. Next question, I'm actually going to pass it on to Martin. Martin, how much longer can the bull market continue?
Well, the thing is, many markets overshoot, and so nobody really knows how long the market is going to go, or how high it's going to go, when it's going to get there. Anyone who tells you that is kind of misleading you, I think. What we can do is kind of look at the tapestry at the top of the market, or when the market looks like it's forming a top, and look at some of the indicators that I showed you in those slides. That would be the margin, debt momentum, the future capital expenditure, and other long leading indicators of the economy. And one of the things we're missing at this point is for short-term interest rates to rise, because typically they're going to rise before a market peaks out. And I see even from yesterday, the Fed Open Market Committee was a lot more hawkish than it was in its previous minutes. So they're beginning to get the message because of those inflationary pressures which are taking place. So this is the kind of thing, and the other thing I would look for is if when stocks begin to underperform commodities, they can deal with rising commodities up to a point, but later on they run into problems when commodities move up too much. So in summary, I think it pays to observe what's happening rather than speculate about what might happen.
Good answer. Thank you so much, Martin. And for this next question, I think, Jim, it'd be great for you to answer, which is, what would make you become more defensive?
And that runs along with what Martin was talking about. And there's a few things that we want to watch and look for. First would be the deterioration in our investment barometers. Martin has studied these indicators back to the 1950s. And he would be the first one to admit that they're not perfect, but they certainly have a good track record and has helped add value over time. So when those start to weaken, we would look to trim back our stock exposure. Another thing that we're always looking at are the economic trends, or where are we in the business cycle? And if the evidence says that we are either heading toward a recession or more likely going to a recession, that would be another indicator that we would want to get more defensive on. Third is looking at the market itself or market leadership and breadth. If fewer and fewer stocks are driving the market higher, that's a narrower environment, and that means it's getting more risky. And fourth, Joe touched upon this, but sentiment. There's a famous line from Warren Buffett where he says, "Be fearful when others are greedy and greedy when others are fearful." When investors get too optimistic, we start to get a little more cautious. And today there's certainly some pockets of euphoria, but those could get even more extreme. So we're on alert. And as Joe mentioned, we're still dancing. We're dancing a little bit closer to the exit, but we also have a plan for when we need to leave the party.
Right. Good points, Jim. Thank you for that answer. And I'm going to pass this along to Tom. The other question that was asked was, how do you protect portfolios in market declines?
Well, that's a good question, and that's one we ask ourselves every day. I mean, we come into the office, and that's the first thing we're thinking about is how can we protect portfolios? Clearly, we're going to reduce stock exposure. We're going to take incremental steps to lower your risk in the portfolio. Maybe not all at once, but gradually. We're going to raise cash. And treasuries at that point, might be attractive in terms of yields being attractive. Generally, if we're going to go into a recession or a slowdown, interest rates will come down and treasury prices will go up. So that adds good quality, what we call ballast to the portfolio, keeps it anchored a little bit, prevent it from going down too much. And lastly, of all our stock holdings, we're going to make sure that we're going to hang on to the higher yielding stocks that have the lower historical risk to them, that are less volatile than the others. So overall, we're going to definitely bring the volatility of the portfolio down. A proof point is what we went through here just the last few years. 2022 was the last bear market. It actually kind of took place over the entire calendar year. And if you look at the calendar year returns in different assets, the aggressive NASDAQ type growth stocks went down the most. They were down 32% in 2022. That's a tough haircut there. The S&P 500 was down about 18%. Even real estate investment trusts were down about 26%. And aggregate bond prices were down double digits as well, down about 12%. So the only asset class that actually went up was cash, where just earning 3 or 4% was better than any other asset class out there. So we'd like to point to that bear market as a proof point. I think the typical Pring Turner account in that environment was only down about 5%. That's no fun to lose money in any given year, but being down 5% when the rest of the asset classes are down double digits is, we think, doing a good job. And it's much easier to come back from a 5% decline and reach new highs in your wealth in the next bull market. Versus having, 20, 30, 33% decline. Coming back from that is a lot harder and takes a lot longer. So that's the most recent example, but you can go back the whole history, 50 years, not our first rodeo. The 2000 to 2009 period was a period where it was termed the lost decade, where stocks actually produced a compounded annual return of like negative 5% with dividends. That was a rough environment, but Pring Turner produced single-digit positive returns throughout that period. There were periods of growth and periods to protect, and assets to avoid and assets to emphasize. And we were able to pick our way through that 10-year period and come out in good shape on the other end. So whatever comes our way in the next 10 years, we think we have the right process and flexibility and adaptability to adapt to whatever comes next.
Awesome. Thank you, Tom. And for the very last question, I'm going to pass it along to Joe. I think you'd be perfect to answer this one. And it is, what is the most important lesson in your experience?
Aha. Well, it's something that is spread through the entire fabric of Pring Turner. But let me begin with a predicate here, though, that the lesson learned is due to two things, and that is, it is our opinion, our belief that Wall Street is designed to separate you from your money. And you could add to that, human nature is designed to separate ourselves from our money. So, uh, with that in mind, then a word or words and a phrase or two that you have heard throughout the presentation today um, is the word discipline or process, and the phrase is manage risk. So I would say the most important lessons are that to manage risk, you have to have a disciplined decision-making process, and then you trust that process. So we've worked really hard over the years to develop the tools to help us do both of these things, manage risk, and we have used the knowledge and the skills, and now we have experience, a few years combined, to uh, manage the process, use it, improve it as we need. So I would say that's the most important lesson. Manage risk and have a disciplined process to do it.
That's exactly right, Joe. Now, Joe and Martin, would you mind reading this quote that the team came up with before we lead into the live Q&A?
We don't know exactly what comes next. Nobody does. What we do know
Is how to manage through uncertainty with a disciplined process that we've built over nearly 50 years. Thank you.
All right. Well, thank you so much for everyone who has stayed with us this long. We do have some questions that have come on in, so we don't want to waste a minute. I'm going to get started on them, and let's go ahead with question number one. Who would like to answer this one? How many months of withdrawals do you target to keep in liquid cash? And what's your strategy if yield rates continue to drop?
Well, I can start off on that one, Pamela. And I'd say there's a good rule of thumb, and this isn't just on cash, but in investments in general. You don't want to own a stock or hold a stock if you would have to sell it in under, we'd say 2 to 3 years. We'd like to have a longer term horizon on it. It depends obviously on where you are in the business cycle, but so you can kind of work backwards to figure out, well, how much would you want to have in bonds and how much would you want to have in cash set aside? And you can kind of come to your own conclusion that way. You also just want to figure out what it depends on the individual's risk tolerances, what their goals are, in general. So there's lots of different things that play into it. But yeah, if you're tapping into the portfolio really hard, to the point where you're going to use up, you'd have to start hitting some of your stock investments or selling those before that time horizon. That's normally not we'd want to look at things and make adjustments there. But there's been lots of studies, and they like to say if you're at 4 to 5% withdrawal rate of the portfolio, theoretically, it could last forever. I mean, not every long-term environment will help you generate those returns, but that's kind of a good rule of thumb.
Yeah, great answer. Thank you so much, Jim. Okay, next question. What mistakes do you see people making when they're nearing retirement or just starting into retirement?
Take a stab at that one, Pamela. I think it's wish and hope. So I think the idea is to be realistic. And one of the greatest hazards that people, just stepping into retirement have is what's called sequence of returns. So, it's just go in with a conservative attitude and just have an attitude of being risk averse. And I think those are the two most important attributes to have as a incoming retiree. And being one of those, I can confirm that.
The other thing I'd add to Joe's answer, which is spot on, is you want to be planning for retirement in advance of your retirement. And Pamela, maybe you can speak to this being the financial planner in terms of there's some things you can do ahead of your retirement that really set you up in a better position for that. So I don't know, Pamela, if you have anything to add there.
I actually was going to mention outside of the investment side of things, there are some lessons that we've learned with clients that have really made a difference. And so if you're pre-retirement or even you're a retiree, doesn't matter if you just retired or if you've been in retirement for 20 years, there are some things that can really help with peace of mind, which is what we really we value here as an entire team, and we try to offer our clients peace of mind over the protection and growth of their portfolio, but also just with the care of their own family, their own legacy, their own wishes. And so from a planning perspective, again, pre or during retirement, is just having some of those estate items in place that can really make a phenomenal difference for your loved ones. So, having your power of attorney set up, having a legal will in place, maybe that's ensuring if it makes sense for your situation, setting up a trust and having your accounts titled in the trust or ensuring that your beneficiaries are current. That's a big one that has been a big lesson and could be a really hard lesson if they're not updated. We definitely go above and beyond to try and make sure, those items are in place for our clients, but certainly even for your friends, I encourage you to talk with them of just making sure that they have their own personal legacy protected with some of those items. Great. Okay. So next question, Martin, I'm wondering if I could pass this one along to you to start it off. It's a great question. Has the political climate and Iran war caused noticeable improvement or deterioration in the indicators?
Yeah, I think the war has accelerated commodity prices rising, and now we're seeing a correction now. So the next thing to watch for is whether or not the commodity is going to make a new high, and whether the oil does as well. But it's obviously not possible to predict such things in such a volatile environment. So we have to go with what we see at the present time. As Joe always says, it pays to observe what's happening rather than speculate about what might happen.
Yeah, just to add onto that, Pamela, is fortunately heading into the war, the market was in a good position and the economy was in a fairly good position. As Tom mentioned, our investment barometer was strong. And so it was able to weather that storm. And it was very volatile time. And that's why we don't just look at, say, the primary trend or what our barometers are saying, but we also look at other, what we call our intermediate model or fuel tank, which can be really helpful during that time. In fact, it was a very scary time, war going on, stocks going down. It can be difficult. And so it gets back to Joe's point about having a process and trusting your process. So it was really helpful for us to have that intermediate model. And it was kind of telling us, hey, there's a lot of panic out there. And the model isn't perfect, but it gives you an idea of, okay, what's the odds that you get a strong relief rally out of here? And it was saying it was pretty high. And so that ended up happening. It wouldn't happen every time, but we had a plan for if we don't see a strong rally, then maybe we are near the end of the business cycle. It's time to start getting more defensive quickly. And we took a few baby steps to move that direction. But now we're seeing the signs that the breadth is starting to strengthen. It's starting to pick back up. And so, as Martin said, we're not trying to predict. We're following the models and just making incremental adjustments as we can.
Yeah, excellent answer. Thank you so much. Question 4, it looks like this might be a good question for Katie. And it was, can my adult child have access to my accounts? I don't want them to have ownership. I just want them to be able to help me when I need it.
Yeah, I'd be happy to answer that. That's a common request we get very often. There are two types to go about this. One of the options that we have on your Schwab accounts is called view only access. What it allows your adult child to do is basically access your accounts online, look at investments, look at statements, basically view everything, but they don't have any ownership capabilities. In other words, they cannot transact on the account, they can't make withdrawals, they can't call us and request a withdrawal. Basically, view only is just as it states on the Schwab form that you would fill out for that. They can just view everything, help you out, maybe help you answer questions about what's going on in your account. Another option is power of attorney. There's a durable power of attorney, which it really is just, it goes the way it sounds. It's durable even if you can't act on behalf of your account. So it is full capabilities. It's not ownership, but they do allow you to transact on the account, make trades, make requests. So it does have a lot of the ownership type of relationships on there. There is a limited power of attorney, but again, there it's not may not be durable, but you can still transact on the account. And so with those three different options, really, if you want to just give me a call, if this is something you'd like to add, we can kind of go over the differences and basically what would work best for your particular situation. What's nice is there's an option out there for everybody to make them feel comfortable on what kind of access their children have to their account. So that's it. Yeah.
Yeah, I think that was a perfect summary. Thank you, Kate. And next question. This is about IPOs. So we just experienced one mega IPO, SpaceX, and two more on the horizon, Anthropic and ChatGPT. Why is this happening now? And what, if anything, does it imply regarding the market going forward?
I'll take a first stab at that, Pamela. That's a tough question. And I'd say, why is it happening now? To answer that one is we're in the later stages of a cycle where we talked about valuations are high and investors are enthusiastic to get these shares and they're very popular. So an IPO is the only time that a public company gets to pick exactly when it's going to sell. And companies are smart about this. They choose when to do it for reasons. They want it to go well. And so I'd say it's just another sign that we are in the later stages of the cycle. Doesn't mean that we're in for an imminent decline right away, but it gives you an idea of where we are in terms of investor enthusiasm. They certainly wouldn't be IPOing near the bottom of the market or a bear market. So it gives you an idea of where you are in that sentiment cycle. And, so what does it imply in terms of going forward? Well, for those specific names and investments, I know that they're priced at very high valuations. So you're paying, they're either non-profitable or very little profits for very high valuations. And so anytime, I don't care how great a business is, I don't care how great the real estate is or how great any asset is, if you pay a really high price for it, your future returns might not be that good. And the opposite of that's true too. If you buy something for a really, really good price, it might not be a great asset and you could still do okay. We don't really dabble in that area, but there's some investors that have been very successful doing that over the years. So in fact, that was Warren Buffett's first approach when he started investing when he was younger, was buying undervalued companies that weren't very good and then selling them for a profit. So in terms of implying for returns, it really only talks about the returns of those specific investments themselves. But the whole market, especially in technology or anything AI related, the valuations are higher. So you would expect the future returns, long-term returns, to be lower. But that's long-term. We're talking 5-10 years. It doesn't mean that they can't continue to run higher for the next year or two or three. Maybe Joe, you can talk about how crazy it was in the late 90s and how long that run went up with IPOs.
The uh, Thanks, Jim. Martin and I, last time I visited him, had a book in his library, and I think the book was probably circa 1930, late 30s or something. A book by Colonel Ayres, who was a very astute observer of markets. And he has a chart that shows when IPOs, tend to come out uh, in force, and it, as you point out, Jim, very close to market highs. So it's because there's so much enthusiasm. I'll fall back to Pring Turner's first rule, which is the stock market is designed to separate you from your money. So sometimes it's like, oh, it really looks exciting, but as Jim says, maybe the returns might be a little slow in coming. And in fact, if we look at SpaceX, Jim, which I think maybe the question might be framed around, isn't it down considerably from its IPO offering price?
No, I think it's around that price.
Aha.
I don't think it's gone below. But both of you alluded to the sentiment cycle, and when you get really crowd psychology moving to an extreme, certain statistics kind of stick out at you. At the height of the Japanese real estate boom in 1990, it was said that the value of the emperor's palace was worth more than all the real estate in California. And at the 2000 top is the famous quote about Priceline, online travel agent, being worth more in terms of capitalization than the rest of all the airline stocks put together. Today we have an interesting thing with Nvidia, worth about $5 trillion at its height, equal or close to equal to the whole GDP of Germany, which is the third or fourth biggest economy in the world. That doesn't tell us that we have to sell, but it tells us we're getting into kind of into la la land here a little bit.
It also fits in, Martin, with there's been a definite current in the market with anything that's been AI or space or beneficiaries to that trend. The momentum on those stocks has been really strong, and kind of the boring businesses or non-sexy or even these businesses that we like to say boring is beautiful, and we're fine owning those types of companies that have been around for 50, 80, 100 years. Union Pacific, I think I always like to reference, I think it's paid a dividend. I'm going to botch it, but for like 125 straight years or something like that, and Joe talked about how long the history that's encompassed the U.S. history. So Union Pacific, the railroad's been around a long time. It'd be very hard for me to foresee an example where that railroad is not around 100 years from now. It's just very difficult to build another one if we took all the money if Elon took all of his money and tried to build a railroad, he couldn't. In fact, that's why he wanted to do a boring company, right? To go through underground, because he couldn't lay the track on top of the ground. So anyway, I'm getting a little bit off topic here, but those more boring businesses aren't in a huge valuation bubble like some of these other sexier businesses are. It doesn't mean that if you have a bear market that those boring company valuations can come down as well, but they're likely to come down less, and we can survive with a much more reasonable drawdown on those types of investments.
That was awesome. Thank you, Jim, Joe, and Martin. That was a phenomenal response there. Now, we are basically nearing the top of the hour. We did have a request to share I'm going to go ahead and share my screen here. We did have a request to circle back to our allocation slide. I just wanted to quickly highlight it one more time for the individual who did request to look at it. Now, with that, we are at the top of the hour. Thank you so very much to all of you who joined us today. We appreciate each and every one of you. Thank you, Jim, Joe, Katie, Martin, Tom. You just are the dream team, and we hope that the rest of you have a wonderful summer.